Welcome, folks, to BTFD TV. We are joined by a regular contributor to this program, Chess and Wine. Chess and Wine is going to talk about the extraordinarily volatile market, I'm certain, and some ideas, no doubt. I just wanted to call out before we got started that I have followed Chess and Wine virtually since I began on Twitter, which is about 7 years ago, I believe. I have also been a long-term subscriber of Chess and Wine. His service is extraordinary, and I just want to call that out. And Chess, anything that you want to add to that at the beginning or at the end, please feel free. And with no further ado, I'll turn it over to you.
Thank you, Bob. I appreciate that. Always great being on. Always great being on with you and Jack and that kind of thing. You guys do a great thing. Great job here with the BTFD TV. I do run the marketchess.com. That's my website. Any details about services, of course, are on there. But I put out plenty of free content as well, so you can kind of decide what works best for you. Marketchess.com. Obviously, it's great to be on here with you on a day like today. You know, with everything going on in markets, really world markets and across asset classes, not just U.S. stocks, of course. It's definitely a tumultuous day. I think everyone who was complaining that markets were boring and weren't going anywhere, this should help, I guess, in a roundabout kind of way, alleviate some of that pain.
Yeah, the PMs that are hanging in the Hamptons have had a heck of a week here, huh?
Yeah, I mean, I think there's an old phrase. I think I mentioned this for members in the midday video. There's an old phrase in economics, which I think is very appropriate for what we're seeing now. Potentially, if this amounts to what we're seeing in terms of, you know, the S&P 500 index maybe breaking down from a very long sideways pattern, the old phrase is basically in economics or markets, what you thought would transpire, what you thought would come to fruition, takes much longer to play out than you ever thought possible. But once it finally starts to happen, it happens much more quickly than you could ever dream of. And I think I talked about that with Jack a little bit a couple weeks ago. And again, that might be the situation here. Of course, we got to see if there's confirmation, if this weakness holds. But all of these divergences, I mean, each time I've come on BTFD TV, I've always mentioned this idea of bifurcation. And what that means is in market capitalism, you're always going to have winners and losers. I mean, that's capitalism, and that's normal to have winners and losers. And in the markets, we would say some sectors, some asset classes are winners and some are losers. That's normal. But when you have these spreads that are so wide and such glaring divergences that it's not just run-of-the-mill winners and losers, but it's extreme, steep, multi-year uptrends versus extreme, persistent weakness, that's classic bifurcation. And usually it does not end well. Again, each moment in the market's kind of unique, to paraphrase Mark Douglas, trading in the zone. But still, I think these are all things that we've been considering. I mean, for example, the transportation stocks, the semiconductors now, after leading into the early summer months, late spring months, energy, of course, high-yield corporate paper, junk bonds. I mean, all of the emerging markets, all of these things may be coming home to roost. It's still, I think, early if this is going to be kind of a deep correction or bear market. So we still have to kind of sort this mess out, so to speak, and figure out, is this just another run-of-the-mill shakeout into late summer, and then after Labor Day, like you said, when everyone, you know, so to speak, comes back from the Hamptons, you know, we'll just conclude the year with a nice rally. Is this the shakeout before the next leg higher in this bull? If that's the case, my best guess is many of these charts need time to repair, because a lot of these charts, from a technical perspective, have suffered damage. And what happened was, Bob, excuse me, I was talking about this with Jack. What happened was a lot of these leaders, big, liquid, glamorous issues with tons of institutional sponsorship in the NASDAQ composite, let's say Facebook, Amazon, holding up well. And I would say overall, if you look at their charts, you know, Netflix is down over 5% today, but it's still in this broad uptrend, of course. And they were holding up well, but holding up well isn't necessarily a buy signal when everything around you, when Rome's kind of burning, right? So the issue was, would these leaders, would they kind of hold things up? Would they be telling us all along the real deal, that all of this selling is much ado about nothing, or were they holdouts, bifurcation holdouts, before they eventually succumbed? And that's really, to circle back to the bifurcation issue, that's how classic bifurcation resolves, is the really strong parts of the market, Disney, Netflix, those kinds of names, they eventually break off, healthcare, biotechs, and then the weak parts, overall, yeah, they can flop around a little bit, energy, all that, but usually they stay fairly weak, and that's the risk, I would say. And again, we're seeing some glimpses of it, but it's still way too premature. I did say we talked about this both on the main site and inside the services, with just the Dow Jones Industrial Average has a declining 200-day moving average. That's a little bit of a concern. And I think now you're seeing the S&P 500, that 200-day moving average is slightly turning down now today as well, and so is the Russell 2000 index. And kind of technical voodoo aside, actually the Russell, I think, is still smoothing out. The NASDAQ is still rising. Technical voodoo aside, some of the old school technicians from 1920s and 1930s, they would argue that meets the technical definition of a deep correction or bear market. When you see on a major average, those 200-day moving averages start to slope down. So my point is, there's a lot of sloppy action out there. I don't think anyone can really disagree with that. And risk, I think this is still a high-risk environment. And I think the real issue, Bob, is it's a high-risk environment, and I'm not so sure it's necessarily a high-reward environment. So it might be one of those environments where playing great defense is really the name of the game. In sports, they say defense wins championships. And I think in speculation and gambling, I would even go one step beyond that and say defense is critical to survival. In a profession where many speculators and gamblers and go broke, especially those dabbling in options and futures. So I think defense is critical to survival, and I think this kind of environment drives that home, and I think it has for a while.
Yeah, I mean, I think that what's critical to mention here. This isn't hindsight from you. This is stuff that you have actually been saying for, I don't know, at least 2 months.
Yeah.
On a regular basis. I think that you have fundamentally changed your strategy as a kind of swing/day trader, in terms of your approach. And I mean, I've seen it on a daily basis.
Yeah, I mean, I try to make adjustments here or there. I do think the bull market went on at various times. Let's say, it went on much higher than I thought at various times. But that's, I think, the nature of the beast. You're always going to find that. I think you're always going to find bull and bear markets go on further than I think even the biggest bull or the biggest bear, even they can anticipate at times, right? And I think the key is always looking at the markets through the prism of risk to reward. I mean, if you're just a pundit or you're just an observer, then you can do whatever you want. But I think if you're actually trading with real money, I think it's not so much a question of making the bold call. It's a question of looking at the markets through the prism, again, of risk to reward. And that's always how I'm going to look at these things. So I think earlier in the bull market, I was singing a much different tune. I mean, I was looking at long-term ideas aggressively. I was looking at swinging trades on the long side, not just for days, not even for weeks, but for months. But and that's fun to do. That's great to do, obviously, especially when you're right. But I just don't think this market environment has been conducive to that kind of trading style. And the irony is, Bob, this has all been happening while the S&P made a new all-time high not that long ago. I mean, earlier in summer, and then as recently, I would say, as Tuesday this week, we were above 2,100 in the S&P cash, and now today we punched below 2,000. So the old phrase, risk happens fast. And I mean, it looked like on Tuesday this week at one point, the highs of the day, Tuesday morning at 2103 on the S&P 500 index, we were within shot of maybe one lurch higher of hitting new highs, right? One big up day, and there we go. But it's not so much a question of whether the S&P makes a new marginal all-time high, even though, again, that's what a lot of people like to focus on. They say, you see, we're in a bull market, there you go. I think the real focus is on looking at the way in which the market's constructed, the real nature of the beast. What kind of market are we really dealing with in terms of individual technical setups? Do we see health? Do we see broad-based health, not just in a couple names? Do we see sectors that are generally, again, you're always going to have winners and losers, but when you have classic bifurcation, how does that get resolved? And with the price action this week, even if you're a huge bull, even if you have the very deeply held convictions that we're going much higher, let's say in the next 6 to 18 months, I think you'd be remiss not to at least consider your own risk tolerance and your own risk strategy and say, okay, be that as it may, where is my max pain on some of these positions? Where am I going to say, okay, maybe the bull thesis is under scrutiny here, is under real scrutiny, is maybe reversing a little bit. And I think this kind of price action, again, even if we get the usual V-shaped rally, I still think it's a good exercise in at least identifying your own risk tolerance as a trader. And in this market, especially for some of the newer traders who came on the scene, let's say in 2013, this market, I think, has conditioned a lot of traders to not really think about that, to always think, well, we hit some oversold oscillator, some oversold condition on an oscillator, and this is where all these prior V-shaped bounces have occurred. So here we go again, and that's been the norm. But the kind of the dark side of that is that the first leg down in a deep correction, not even a bear market, just a deep correction, again, which we haven't seen in many years, the first leg down features a market becoming and actually staying oversold, kind of like what we saw yesterday, right? Yesterday you hit oversold, and everyone says, well, we can't really go down that much more. If we open down lower with a gap down, you got to buy it. It's a no-brainer. And then we walk in today, and I think bulls have tried intraday. The micro caps are green as we speak, but the S&P 500 index is down nearly 40 handles, at the moment, and we're still below 2,000 at the moment on the S&P cash. So you see what I'm getting at, Bob?
Absolutely. And I absolutely concur. Now I just wanted to get some of your thoughts as to go forward. So, I mean, what I hear you saying, and again, I listen to you every day very carefully. But I think I hear you saying, you're not sold that this is necessarily a time to go in all short either.
Well, I mean, I think that's the risk is that, the Fed still hasn't, raised per se, in the sense that this idea of, quantitative easing, the fourth edition, could still be lurking out there, right, Bob? And I think. I think it's a certain degree of respect for the market. And what I would say to that is, think about how many bears who got the thesis right in 2005 about the debt bubble, right? Let's say if you were a bear, Bob, in 2005, and you put the whole puzzle together, if you mortgage-backed securities and which banks were most at risk, Lehman, Bear Stearns, Fannie, Freddie, everything like that in terms of financials, AIG. Let's say you put the whole puzzle together, the home builders, Angelo Mazzillo and everything like that, they were all houses of cards, so to speak, and you started shorting aggressively there at the first sign of any, 1 or 2 days of weakness back then, before equities officially topped out in, let's say, October 2007. If that happened, I mean, there were a lot of bears, Bob, who went broke before the fact. And I think if you look back at the history of markets, there were a lot of bears who probably even saw the 1987 crash coming, but they were maybe a couple months early, and they took just devastating drawdowns. And by the time the actual crash came around, they were sitting there with a super soaker, with what amounted to a super soaker, gun of capital, as opposed to some heavy-duty machine gun, so to speak, right?
No, I mean you're absolutely correct. I mean you look at what the two most notable people are what Dr. Michael Burdy, isn't it Burdy? Of Vanderbilt actually, who said he was the one that identified this whole debt bubble, and then Paulson, who was able to make so many billions off of it. But you've seen his investment history since hasn't been exactly exemplary.
Yeah, I mean, being too early is you know, in some ways the same as being wrong, and it's a reality to be faced. I mean, let's be honest. The market's the ultimate humbling mechanism at times, and I think um, you can be right about this whole thing that maybe we are. Let's just say, for argument's sake, let's just say, Bob, we're in the early innings of some sovereign debt crisis, and Greece is not contained, and this is going to start spreading around the world. And you know, just for argument's sake, you still, as a you know, if we're just sitting in some cafe talking about that, I mean, that's great. You know, you and I could sit there wearing our berets and drinking wine, and we can just, you know, have a great conversation about a sovereign debt crisis and how, you know, how it's going to go, and it's like a great story. It's like we're concocting some kind of novel, the great American novel. But if you're trading the markets, I think you have to respect risk. And what I would prefer to see before, I mean, you know, I've been shorting here and there. I closed out a couple shorts today into this weakness. What I would be looking for to really start hitting the market with size on the short side would be clearly declining 200-day moving averages across the board on major averages, and then, you know, we would rally back up to. I mean, it's a whole process. You rally back up to it, you make a lower high, and then you roll back over. And I think that's a good I think setup for me to start getting more aggressive.
Excellent.
And then as far as let me just say, as far as the idea that, you know, there are great bargains lurking out there in energy or Disney, I think it's really important to look at the multi-year, multi-decade charts. I mean, ExxonMobil, I mean, I know you and I were talking about ExxonMobil. ExxonMobil, I think that's the risk, though. I mean, ExxonMobil probably can bounce here, you know, but ExxonMobil's been in an uptrend since the mid-1980s at least, you know what I mean? And so there is that risk. Disney has tripled, more than tripled, I think, in market cap in the last couple of years, and it's a mega cap. You know, it's not exactly one of these new up-and-coming growth names, right? And
Disney, not at all. Not at all.
Yeah. And Disney has an abnormally steep angle of ascent. And frankly, Bob, I know they have ESPN and all these movies and this and that. You know, if you look online at their ticket prices, how much they charge families to enter their parks, I'm not so sure that's sustainable either. You know what I mean?
Believe me, I've paid it. It's unbelievable.
I mean, that's purely anecdotal, but you can see what I'm getting at. I mean, it's had a great run. A lot of good news has been baked in the cake, and you know, the issue for me was never, am I going to precisely call Disney to, you know, the top of Disney to the T. I don't fancy myself being able to do that. What the issue for me was, what's the risk to reward for me putting money into Disney up here? And I think you know, I've been saying that for a while. Obviously, probably too early, probably wrong. But again, I think you'll see outlier markets come through, and the issue is outlier markets. They happen once in a while, but they're not sustainable. And typically, the other side of the mountain you know, risk happens fast.
I'm sorry. I had trouble myself. I have a brand new puppy in the house too. So,
yeah.
in addition to all my other complications, but you know, were there any specific issues that you wanted to touch on, Chess?
Well, I think the whole crude oil thing. It just seems like a really orderly move down in crude oil. Don't get me wrong. I mean, it's a pretty steep move lower, but it's a kind of methodical steep move lower, if that makes sense. And it would almost be better if we got some cathartic washout in crude. I'm talking like a real spike, maybe down to $35, you know, something like that. A spike. I think that would be, frankly, paradoxical. I think that'd be healthier to help us arrive at some kind of tradable low than it would be just to keep, you know, seeing these intraday bounce attempts, which are faded, and you know what I mean?
Yeah, no, I mean, you know, crude has been, I think, the most interesting instrument out there for the last, I don't know, was it almost 8 weeks, really? You know, where it kind of slowly ticked down, but now you get these violent bounces, as you pointed out, and it's really incredible. Now, you know, just anecdotally, I educated myself recently and kind of learned where I thought fracking was such a high-cost issue, But some of these frackers have gotten their marginal cost down, but basically I think under $40 a barrel.
Yeah.
So that to me is fascinating.
The issue is, will we need to see a bankruptcy? A couple bankruptcies before, before maybe we arrive in some of the energy stocks, right? Chesapeake. I don't know, Chesapeake. You see the rumors of them. BAS. I don't know. I mean, it's something to consider. I just think there's something about the action, and I've said this for a while. There's something about the action in energy stocks and crude oil that just tells me we're not quite there yet, I guess, for lack of a better phrase. I mean, just technically speaking, it just doesn't have the look and feel of a bottom just yet. That can change, like I said, with maybe a cathartic washout where you finally get some real, I'm talking about indiscriminate emotional selling, where people just say, get me out already. I don't know, Bob. I'm not so sure we've seen that. I could be wrong there, but I don't think we've seen that real, like, people picking up their phones and calling their back in the old days, picking up the phones and calling their broker and just say, get me out of anything.
Sold. No, I mean, you raised an interesting point that drives me to another area that I haven't heard you speak about recently, but that is coal. Now,
Yeah.
Coal, interestingly enough, has had a couple of monster. I haven't really looked at it today at all, but they're coming off 2 days of
Okay. Yeah. Yep. I'm sorry. I'm so excited. I'm going to cut you off. I'm so excited. Okay. Coal, Arch Coal, ticker symbol ACI. ACI. Arch Coal. I believe George Soros, the billionaire investor, took big stakes in ACI, and I believe BTU, Peabody Coal.
BTU. I think when you say big stakes, it was big nominally.
That's true. Not for him. Not Soros big. Yeah.
It was only $2 million, I think.
Yeah. So for him, that's not. He's not trying to break the Bank of England or anything.
That's pocket change.
Yeah. It's not Black Wednesday with Soros breaking the Bank of England, but it's him probably putting out little teasers that these guys might be that's really the thing, is like the survivors can kind of breathe a sigh of relief if they're surviving, because we know Walter Energy bankrupt. I think Alpha, everything like that. It's obviously a high risk sector. It's the epitome of a high risk sector. KOL, which has some real interesting components you wouldn't think would be in there. KOL, the ETF, Joy Global still getting slaughtered. The equipment, I think, for coal, but Arch, ACI, and Peabody, BTU, especially Arch, they're acting like they're giving you that sigh of relief rally that, hey, we're actually not going out of business yet. That's what it smacks to me of. They're gonna have to make higher lows now vis-a-vis their basing action over the last, let's say, month or so. Technically, if that's what you're looking for, probably Arch Coal, BTU has to probably hold over $1.40, and Arch probably has to now hold over $2.25, around there, which is actually quite ways low.
Arch Coal's move is unbelievable. You look at the chart today. I just pulled it up while we're talking.
Yeah.
It's unbelievable. It's over $4.
And the weekly buy volume is off the charts. I believe if my charting software, someone out there might correct me if I'm wrong, but if my charting software is not betraying me here, the weekly buy volume for Arch Coal is off the charts. It's I don't know if it's Soros in there again or someone piggybacking Soros or what, but it's unlikely the entire coal sector would be bankrupted, right? For everything the sector has been through, with the president, with this, with that, right? Green energy, everything, right?
Right.
Deflationary forces beyond politics, deflation, right? With everything that's been happening, coal is still a big source of energy. I mean, we're not at that point yet, Bob, where we can just go to the ocean and the ocean geothermal, everything like that. It's going to power everything. We're just not at that point yet. And coal is still a big source of energy, and I think it's important to pay attention to who the survivors are in the coal industry, because inherently, I mean, they're going to come out. They might actually come out of this stronger with more market share, and it's just basic economics, right?
Yep. Indeed. I mean, I honestly, I think it's the most fascinating story in today's market. Put aside, what people fancy for headlines in terms of the big market drop and everything else. But this move in coal, to me, is the most fascinating thing of the week.
There's something to be said for that, and it's very ironic that it's happening when there's plenty of distractions around all of us, right? Because it's very easy for coal to get lost in the shuffle here, because everyone who's tried to pick the bottom has been just decimated. Everyone who's called the bottom has been decimated, and we've seen bankruptcies, and now the market's getting hit. So the last thing you're probably going to think of is, hey, the market's getting hit, and we have all these issues. Let me go buy some coal, right?
Yeah, right.
But ironically, that's when we're getting some clues. And the market's very sneaky like that. And
Yeah.
I think it's going to be interesting to see if Arch, and maybe Peabody, if Arch especially, can hold this move. I guess the real bear case is that this is just the last gasp to trap in people. The whole Soros thing is some kind of red herring, and then everything's going to bankruptcy. But I don't know. I think if you look back at history of markets, there should be some survivors here, and those survivors should probably gain market share. So.
And let's point out that bankruptcy doesn't necessarily mean death. It just means death to equity holders. I mean, the company necessarily survives because, as you point out, coal is still critical for the our energy grid.
Yeah. I mean, it's not. I mean, we're not quite there yet where you can just. I think we're not quite there yet where you can just abandon coal altogether. I mean, I think everyone would agree with that. We're just not, as much as some people I think would like that. I mean, it's again a reality to be faced. So.
Are we hitting new lows again? Because I just got hit with like a bunch of different cells, and
we have the XBI. The XBI is a biotech ETF. I think they have smaller caps. That's green by more than 0.8%. The micro caps are green a little bit.
Uncle
today.
Bob, yes, we're bouncing near the lows.
Yeah.
Wow.
Back to mute.
Sorry.
And the Dow, Bob, the Dow is off 400 points. And
Wow.
yet the XBI is green. And I think what we're seeing, I mean, this is options expiration, so I think there might be a lot of games being played. But you can tell bulls are really going to try now with these micro caps and small caps and small cap biotechs. And if they fail, I think that is when you could see, if they fail, it's a big if because they've had so much success. I think that's another sign that trouble is lurking. This could be much more of a kind of like a global macro event. I don't know if Jack agrees with that, but
Sorry, I was amusing myself on Twitter.
No
What was the
problem.
question? What was the question?
If you thought there might be something more ominous lurking out there in terms of a global macro kind of event or
Yes.
Okay.
Yes, I do. I firmly believe that China is, in fact, in a long-term margin call, and when it happens at a national level, much like it happened to America in 2008, it isn't over in 3 days.
Yeah, I agree.
And what I believe we are seeing are probably liquidity events globally being driven by Chinese needing to pull liquidity back in order to meet their own obligations internally. And when you've had let's put it this way, an economy that grows to the second largest, right, has a $10 trillion stock market, loses $3 trillion in 1 month in losses, the additional $2 trillion is still locked up in liquidity in companies that aren't fully trading. You have a scenario where they are in a global margin call internally. You can't have cabbage being more valuable than rebar and not know that there's implications in other places.
Yeah.
Copper, right, has gone from $4 to $2.30 the last time I saw a quote. I think that quote was yesterday. So, I don't know where it is now. There is absolutely no place in the economy for them to find leverage. And I think that's what we're looking at here is a honest global deleveraging that was caused by the largest population in the world growing for 30 years.
Yeah. I Agree with that. I do think there's a lot of risk out there. Yeah, definitely. I mean, I think that's definitely as I think bigger risk as we've seen out there. I mean, this idea of sovereign risk as opposed to as opposed to the banks in 2008. It adds like a wrinkle out there. I think it adds a wrinkle out there. I think, which is going to be interesting to see how it plays out in markets.
Yeah, all right. So when I started in this industry, it was 1997, and there was this thing called the Asian tigers, and then they became known as the Asian paper tigers, and then they became known as the Asian paper tigers on fire. And we had some devaluations started in, what was it, Thailand, if I remember correctly. And then from there, it started to roll through the paper tigers. If I remember correctly, this is about the last time that China was actually where they did a major change in their settings too. So when we take a look at this big picture, we're seeing what, 22% downgrade in Kazakhstan? Was that the one that went off 2 days ago?
Yes.
We're seeing these events happening around the world, and I think that we're going to see more of them. I would say that America entered this crisis in, let's say 07 first, and in this context, we've left the crisis first. I think this is the second half of a really long play.
Yeah.
And this time, though, I see America as being the best of the worst instead of the worst of the best last time.
Yeah, I agree with that.
I'll shut up again. Sorry. This is your show.
No, I mean, I think you're right in the sense that the whole idea of the U.S. being the best house in a bad neighborhood, like those kinds of analogies. But there's this whole idea though that eventually there's no sacred cows, right? Eventually everything gets hit. If you think back to the end of the last bear market in 2008, people were hiding in names like Exxon. Again, I keep coming back to ExxonMobil. ExxonMobil was actually doing reasonably well throughout that bear market. I don't think it got hit very much. And then all of a sudden at the end, that's when it started to succumb. And that's actually how you knew, ironically, that the bear market was probably close to concluding, because the safe havens, the safe harbors, they actually eventually get hit. And so it's going to be interesting to see, again, if the U.S. can continue to show that relative strength that they had. Obviously now it's showing some cracks in the foundation. So,
agreed. Just I don't want to keep you too long. Was there anything else in particular that you wanted to touch on or hit? I mean, I think we talked about global energy, which I think is so critical to this current market. We talked about China a little bit here now. I mean, I think that the China news last night absolutely crushed futures.
Yeah.
I mean, I don't know if you saw that live. I happened to be sitting at my terminal and absolutely saw it hit. And it just, the SPOOs just went, they just fell through the floor.
Yeah, I mean, I think these kinds of markets, I guess I'll talk about it this way. Yes, I mean, I think people know, Bob, I mean, what Jack just said. I mean, you guys have a lot of experience in that arena. What I can say is I think from a psychological and kind of emotional point, the mental game of these kinds of market environments is really important if you're a trader. Again, if you're trading with money, this is really important because there's a lot of, and I joke around a little bit on Twitter. I think there's a lot of people out there who you have to have a certain Jekyll and Hyde personality. I think you can look at the economics, you can look at markets, and you can have an ability to maybe joke around and see for what it is. But when you get down to business and you're looking at charts and you're making trades with money, you have to have that Jekyll and Hyde. You have to detach yourself from the anxious energy that's all, especially if you use social. We all use social media. you have to have a certain emotional detachment because it's very contagious if you see people getting really anxious with a lot of anxious, nervous energy in these kinds of market environments, and then it can adversely affect you. And next thing you know, you're getting really jittery, you're making emotional trades, you're over trading, you're betting with too much size, and these kinds of markets are fast markets. They can be very fast, and so I think it's very important to try to stay level-headed. I mean, that's inside the service for members. That's one of my that's definitely one, I would say, of the calling cards of my service, I think, is that I really want it to be kind of this level-headed kind of sanctuary for traders where no matter what's happening with markets, whether they're up, whether they're down, whether they're boring, whether they're fast, again, you'll get this kind of level-headed sanctuary where you won't, because energy can be really contagious, and again, I think it's really important in these types of market environments not to get caught up in that, especially with the overnight moves and this and that. You always want to be focusing on, not so much short-term results, but you want to be focused on your decision-making. Regardless of the short-term results, is it the correct decision if you keep making that over the course of your career? Position, and then, of course, position sizing, because you got to keep having capital to get through your career. Risk management in terms of stop-loss discipline and respecting it, and managing winners too, if that not getting too greedy in fast markets or markets which may be high risk and small to moderate rewards like this one. That's, I think, those are the concepts I think to be thinking about in this market. If this kind of price action continues, and even if we don't, let's say, fall into the abyss next week, let's say we just kind of flop around like a fish out of water next week, I still think those are the concepts to keep in mind. So I think it's a good way for
Chess, just as we're tying this thing up, I just wanted to thank you, and this really reiterates a private message, a DM that I sent to you quite some time ago, about how I have seen my trading, and I've been trading full time for about 10 years. I've seen my trading improve, and it's basically kind of listening to you and listening to those basic concepts about risk management. And guys, especially for new traders that have only seen the bull market run, that's, I think, going to be critically important going forward.
I do. I mean, I think, when you're in, this is serious business. I mean, gambling, speculating, whatever you want to call me, we're wagering on outcomes that have yet to be determined. That's my own personal definition of gambling, and so this is serious business. Throughout my life, I've experienced gambling in different arenas, and in poker and casinos and that kind of thing, in chess tournaments when I was a kid, and I think, when you see various degrees of speculation on different levels in gambling, you realize, again, it can be very serious business when you're dealing with money. And, yes, it's important to have fun. It's important to, enjoy what you're doing. And it's important. Yeah, of course, we're in the business of taking risk. But, again, you always have to be thinking about your risk of ruin every day. I know that that's not a very sexy or glamorous way to think about it, but I think to think of gambling or speculation in terms of being a glamorous or sexy profession, in terms of all the, all of the great, nightlife and all the glamour and everything like that, I think that is a very dangerous game. I don't necessarily think that's sustainable. I think the survival mechanism is kind of embracing this passionate grind on a daily basis that it is, because to me that's what markets are, a passionate grind. It's always thinking about risk of ruin. It's always thinking about playing great defense. And, yeah, you pick off winners here and there. But, again, that's not always going to be the case per se, Bob. I think there'll be other kinds of markets where, I'll be much more inclined to open up my game and be offensive-minded. But there's always going to be that defensive nature lurking below the surface. You see in sports all the time. In terms of most teams that win championships, you look at football, you look at basketball, baseball. Most of them are going to be playing great defense. And I think that's sports. This is gambling with speculation, with real money. And like I said earlier today in our segment, I would even go one step beyond winning champions. I would say survival as a speculator hinges on playing great defense.
No, I mean, I can't. I absolutely concur with you. And, again, I just merely point out to anybody that's interested, Chess does run a subscription service. You can find out about it at marketchess.com. I'd like to thank him for joining us today in this very tumultuous market. Folks, you have less than an hour to go. Survive well and have some fun this weekend. And hug your kid, hug your wife, hug your significant other. Have a blast. Be well.
Thanks, Bob. Thank you, Bob.